Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, February 7th, 2016. And I wanted to take a look at the U.S. equity markets in this video. I'll try to wrap this up quick. The game is about to come on. A few things to look at here. Really, we'll go over the good, the bad, and the ugly. For quite a while, I've been making a case. The longer term case remains ugly, and stated many times over. Going back for a while now, we're probably in a new bear market and have been for over close to a year now. But what I'm seeing at this point is, most importantly, we're on the edge of a technical cliff. A key support shelf. And yes, there are resistance levels along the way, but we're looking at moves down in the broad markets, and that could be anywhere in the 15 to 20% range. So we really, where we're at right now, like I said, is a key technical juncture, and I'm going to go over some of the worst case scenarios and some things that are giving me pause right now. These charts look quite bearish longer term, but it's the near term action. I think a case can be made that we may hold these support levels we're on at least for a little while here, and if not, if those levels go, then there's some downside, and then we can hopefully position accordingly and try to game some of that on the downside. So starting out here, we're looking at the S&P 500. This is a weekly chart, weekly time frame. I've covered many different iterations or versions of this same chart. This shows a couple of trend lines, all of which have been broken, and this is really, if you look at this from a long-term perspective, we have I have a key major target area here. It's around 1580, which before all is said and done, that would be what I'd refer to as my minimum downside target. If indeed this is a new bear market and we're headed lower in 2016 and possibly beyond, I think there's a good chance we see that level on the S&P 500. Let's just see if I have it on this chart set up on the NASDAQ. NASDAQ 100, hard to say, but I think that's some pretty realistic target somewhere around the 2,900, 3,000 level. Don't have my targets on this chart. There's also a pretty nice support level here, about 3,404. So again, the most important thing here, these long-term uptrend lines, such as this one here, we've had breakdowns, and the NASDAQ was the strongest holdout of all. The NASDAQ making highs just recently this fall, where the rest of the indices peaked earlier in 2015, and so far you never regained those highs. So longer term, things don't look that hot. Let's start looking at the shorter term charts here. This is the daily chart of the NDX NASDAQ 100, and we can look at, we'll take away those lines. We have this key support level we're sitting on right here, and we're just below it. Now, it's not super well defined. It was pretty well defined back here. We had some reaction highs. We had that big meltdown in August. A couple of pierces below there, and we did close below there Friday, which net that's bearish. And what I'm sure a lot of people are looking at and talking about are the bear flag patterns, either bear flags or bearish pennants in all the major indices. And if those do play out, and that's very much a possibility because they have broken down. I mean, this looks like a textbook bear flag breakdown, and that would take us about down to that target level I have here on the NDX, about 3,700. So to quantify it from where we're at, where we closed on Friday, let's just see if I can. Well, I can do it this way: 3,700. Take that away. Grab the bottom of Friday's candlestick, and that puts us down about another 8% downside, and that can happen quick. When the markets go down, especially in these type of waterfall sell-offs, we could make it there in just a couple days. We could make it there easily by the end of the next week, this coming week. It's certainly a possibility. But we're not there yet. There is some support here. We're a little bit below it on the NASDAQ 100, the S&P 500. Let's take a look. And see, I have a better chart here. You can see the flag pattern right here. We do have a pretty decent support level at right about 1870. We closed at 1880 on Friday. So if you look back, there's numerous reactions here. Let's go back on a 2-day time period. That's a busy chart. Let's go back where we were. Okay, we're back on a daily time frame. Now we had almost on the MACD positive divergence, but we didn't. The MACD made managed to make a lower low by a small margin, but either way, had we had some nice strong divergence, we did at one point, but we kept burning through that divergence. So now that after the bounce, when the MACD curled up, we did have a nice positive divergence on the RSI. So this is one thing giving me pause here. We hammered, if you look at this level here, we hammered off support, which was defined by this previous reaction low back in October of 2014 and these other reaction lows. So, net, that can be construed as bullish on the S&P. We had that big wash down move and we held that support. We're at support here. So we could see, it's possible if there is a little more downside, and I'm slightly leaning that way, towards that way next week. I don't think the risk reward warrants betting it hard if you're not already short here. If you're a long-term trader and you've been positioned short for a while, no reason, just keep your stops in place and trail them down. But looks like about another 2.5% downside on the S&P if that's the case. Now, if the bear flag scenarios play out, even close to their projection, and unfortunately, for the markets, a lot of these targets actually measure out to some pretty decent support levels. If you look at, and let's see what this one lines up. I'm doing this. I haven't marked this chart up yet. So what I did, if you didn't notice, I just took the move of the flagpole, which is the impulsive selling leading down into the bear flag pattern. You place that at the highest point in the flag before it broke down, and that would give us a measured move to around the $1,700 area. And let's just see on the charts. Okay, yeah, there it is. That's there is some pretty decent support there around the 1700, and that's where that flag pattern measures. So again, the potential is there if we can't hold. So like I said, I'm going to do. I see mixed signals here. I'm trying to take a look at the charts as open-minded as possible right now. And something to point out, these bear flag patterns, they don't always play out. Here, this was a very nice looking flag pattern. It was a little on the large side for a bear flag, as you can see here. But we had a very impulsive move leading down to it, a move up and a breakdown, which happened to be a false breakdown. And that was very bullish. When you have these false breakdowns of a flag pattern, and then a sudden prices tend to hold and then shoot back up, you can see the strong move. So that's always a possibility here, and that would look something like this. Maybe a move, if we continue lower next week, Monday, tomorrow, maybe a move down to that 1820 area and then a reversal there. And there's a couple other things I'll get to which give me pause. So that's the S&P 500. And okay, jumping over here to the NDX, the NASDAQ 100 on a 60-minute time frame. You can see that we're at that previous reaction low. That's right about where we closed, give or take, on Friday, and I've labeled that for a while as a critical support zone. So the NASDAQ is right now probably the most precarious, in the most precarious technical position of all the major indices, and it has been the leading index. So this is something to be concerned about for the markets if we can't hold that level. So these are just upside targets if we happen to bounce. And again, depending on where we go next week, I think we'll have a good idea next week where the next big move in the market is. But you can see we've been flirting with these support levels here, and we had a couple reaction lows. I really should put a line right here. This is really the most important level now, and that's about 40, call it the 4,000 level on the NDX, because we have a reaction low a little bit below that, a couple reactions back here. So that's what the NDX looks like in the near term. Won't look good if we see a lot more downside. Now, one possibility, it's not uncommon to see a little flush out move, a little false move. And in fact, as close as we are to that level, coming back down to there again, and just looking at the charts, if I had to put odds, I would say that we get a little bit slight downside, a little, maybe a false breakout like we had in GDX recently, a move below those support levels, which would really usher in a lot of short selling, blow out some longs, and then the market has the potential for a sharp reversal. If that happens, that would be a fake breakdown or a bear trap. So that's one scenario I'm on lookout for next week. And if you notice down here, if that scenario does pan out, we have potential divergence. Now I've zoomed out to a 2-hour time period, so a 120-minute chart, and I can draw some pretty nice divergence there. and I put a lot of weighting into these divergences. They often indicate a pending trend change. Now, if the MACD and the RSI continue and they head much lower and take out these previous reaction lows, then that will negate, if you will, those potential divergences. But right now, there's a possibility. One thing I have to see is the MACD turn back up. The MACD needs to roll back up, make a bullish crossover while putting in a higher low to help confirm or put those divergences in place. Really, I should say. Right now, they're only what I refer to as potential divergences. They are far from being confirmed because the MACD is still pointed nearly straight down. So, as I said, this would be an ideal scenario. Maybe a gap down tomorrow, followed by some selling, and at some point, whether it's immediate or intraday before the close, reversal, and then just like with GDX recently, once if and when we regain that level, that broken support, that would be where you would see most likely the bull trap or the bear trap start to play out, with a lot of buyers stepping in, shorts covering, and a sharp move up. So that's one thing I'm on the lookout for. Okay, this is the NDX, just looking at a daily time frame now. Again, the bear flag patterns, which are, I'm sure those are well watched right now at this point. There's the flagpole, and just taking that flagpole and adding it to the top of the flag gives us a measured move down. And as I mentioned, a lot of these, this isn't pure coincidence. Very nice support here with that reaction low back in late 2014, the reaction high back here in early 2014, and that would take us down to that 3,700-ish level in the NDX. Okay, quick look at the midcaps. Midcap index, S&P 400. Very clear bear flag pattern, flagpole, and that would project down to about the 1150 area. So again, if that plays out, we're talking a move down, and at least in the midcaps, maybe about 10% or so. Although we're still just above this support line here. I have an orange line that defines support, and we've yet to take that out. And so again, maybe another little flush down move next week. But bottom line is, I think it's best to keep things light at this point in time because a case can be made either way. Zooming out to a weekly time frame on the mid caps, this is a 10-year weekly chart. And this is a very clean chart in my opinion. Well-defined uptrend line, the bull market uptrend line off the 2009 lows, breakdown, back test. Prices drifted higher after the back test and just rolled over, sort of in a rounded top pattern. We had this little other minor trend line break. And you can see here, this is what I'm talking about with support. This is a key support level around the 1250 level. And the mid caps are an important index. I don't cover them as much as the large cap indices, but they are important. They do make up a bulk of the stock market, or a good part of it. And you can see the reactions there. That's 3 reactions now at this point, and we had some reactions underneath. And then between there, I don't know if you can make out this volume at price histogram, the green and red bars. I have the colors sort of muted down on this chart, but it's pretty thin. There's a thin zone between there, and that's why I don't have. Of course, there would be some support levels and some counter trend bounces along the way if we do move down. But there isn't a whole lot from where we're at currently down to that target level here around the 1025 area. So you're looking at a potential drop in the mid caps before all is said and done. And when I say major target area, that would be my minimum bear market target in the and that's about a 20% drop in the mid cap. So as much as we've already come off the top, there's still plenty of meat left on the bone in this bear market is what it looks like. Okay, and last of the charts, then I wanted to look at a couple sentiment measures right now that are also giving me pause. This is the Russell 2000, a weekly chart, 10-year weekly period, and for years now I've talked about these Fibonacci fan lines going back, and just how well the Russell has acted off these. I'm referring to the purple lines here. They're Fibonacci fan lines. I just put the starting line on this first uptrend line off the 2009 lows. And you can see it acted as support when prices broke it. Very impulsive move down, once confirming that was a well-watched level. And I had a trend line there as well. You can see just underneath. And you can see how well prices behaved off that trend line, finding support. They actually had a brief pierce through to hit the next fib fan line, came back up the following week and rode up along that line of support, broke down, back tested below it, fell right away to the next fib fan line, and again, just look at all the beautiful reactions off there, breakdown, back test, came down here to, and I projected at the time that once we moved away from this trend line, this would be the next tag of support, and we did. We hit a perfect tag of that final fib fan line, bounced off that for several weeks, couple months, and have recently broken below it, and that most likely indicates that was the final move in the bull market. The bull market ended here in the Russell. That one's officially, like I said, a lot of these indices are already in official bear market territory. The Russell's down well over 20% off its highs. I believe the Midcaps are also officially in a bear market. It's just the holdout is the NASDAQ 100, and the S&P has a little work to do. But there's a pretty solid support level here. I should say a decent support, but ultimately my downside target on the small caps is here around the 865-ish level, and you can see the divergent high in place on the weekly chart. So everything else, this was a case that was made last year. And take a look at the daily chart. Okay, so on the daily chart we have again very nice, well-defined looking bear flag pattern. There's a flagpole. You can see the Russell. You can see that it's already broken down from that flag pattern. And if I add the measured move there, it looks to be about the 870, a little bit above the 870 level. Again, the measured move. And I always take these bull and bear flag patterns. I take the measured move, and then I take a look at the chart and I see where my support and resistance levels are. So in this case, I have two lines. I have one about 870 and another support level about 894. So in this case, I'm not short the small caps, but if I were to be right now, that would be my target. I would be looking at the upper line. The measured move comes right between the two. You don't want to stay short and risk a reaction off that first level. In fact, that's where I would expect a reaction. But you have to take it all into account, what the NASDAQ's doing at the time, what the S&P 500's doing, the mid-caps. In other words, if they look to have more downside as the Russell approaches that level, if and when we get there, then more than likely I would extend my target down to that 870 level. However, if it looks like the large caps are poised to reverse as the Russell approaches this uppermost trend line or support level at 895, then that would be the target and most likely where I'd cover and or reverse long. Okay, and we're going to wrap this video up with looking at two other metrics in the market. Enough on the charts right now. Let's look at the put-call ratio and the VIX. Those both work as sentiment indicators, and sentiment indicators are they're contrary or contrary indicators. So when sentiment is excessively bullish, then you want to be bearish, and when sentiment is excessively bearish, you want to be bullish or long, for the most part. And of course, you want to scrub that with the charts. You don't short the market just because everybody's bullish. The market sentiment can stay bullish for many months and at times years. Now these are charts we'll expand on. This is a post that was published on the site on July 21st last year. So July 21st, 2015. If you want to reference that post, it was titled U.S. Equity Market Overview, Video and Static Charts. What I'm looking at here are a few static charts. I won't spend a lot of time. This was a case that was made back on July 21st that the markets were in trouble and we were likely looking at a big move down. And this was high yield credit spreads. In other words, I pointed out a dangerous spike in credit yields. As the market was still moving up, we saw credit yields spiking, which indicated there was trouble under the hood. Stocks shouldn't rise, and I pointed out a similar move that occurred right before the financial meltdown and the market top in 2007. October 2007. So that was something we looked at. We looked at the percent of stocks above the 200-day moving average in the market declining. This was a measure of market breadth deteriorating and pointing out how we had corrections in the past. So all these charts played out again. This was back in July, end of July. But the ones that I wanted to point out here, this one in particular, this is the CPC, which is a put-call ratio. And that measures how many the amount of puts against the amount of calls in the market. Puts are obviously bearish bets on the market. Calls are bullish bets on the market. So when the CPC drops, that shows you have a very little fear in the market. You have a lot more call buyers than put buyers, and that's what happened back here. I pointed out a double tap. I use this red line, these extremely low readings that happened. We had it back here in October. In October of 2007, right after the market peaked. Maybe that came out. Actually, that looks like December. I'm sorry, December, and there was a 55% drop in the market that followed that spike. And along the way, within this bull market, we had two major corrections. One of 17%, one of about 21%. So again, this chart speaks volumes, and it played out there. We had this was the forecast that I had predicted at the time. I had a drop from there, and let's take a look at where we're at. Okay, so now we'll fast forward to today. This is the same chart. Let's try to center this here. Okay, we got the bottom in there. Okay, this is a CPC as of today. So there was the pointing out those double taps. Actually, we ended up a triple tap, and there was that projected move, and that's actually about as much as we've fallen, and we're back to that level, give or take, a little bit hair lower. But what I want to point out now, we already know that, okay, that's history. Anybody that followed the site, this post was on there at the time. Now going forward, let's take a look at another line that I've added to this chart, the green line up here. And what this shows, the green line is at a level of about just under the 150 mark. And what I've done, the dotted lines are just vertical lines that show when prices on the CPC have hit or exceeded those levels. And what you want to take a look at is what happened to the market right after that. So going back, and this is all the way in 2007 here. So we had a double tap or triple tap right here, meaning 3 consecutive hits. And you can take a look and see the market moved up nicely. Okay, we'll draw it out there. So we had a bounce, again, bounce, and you can pause this chart and look. I'll try to keep this quick. Now, this was may not look like much, but that was a sizable move. We came a little bit lower there, and so if you look over the next, that looks like a rally lasting about a month or so. Again, we were in free fall mode at this point, and this was in October of 2008, so when things really just started falling off a cliff. And again, it may not look like much, but if you take your charts and measure from this point, I'm sure that's a sizable move, probably anywhere of 8-10% or more. We had a little bit of a rally here, not too much in this one, but it did come right before a second low in a substantial rally after that. Again, similar thing here. We had a lower low right after we reached that level. So we were near the bottom. That's my point. We were either at or near the bottom when the CPC came up and hit this 150 level, about 147. And you can see it predicted some pretty strong reversals. And then more recently, we had one that nailed the bottom right here when this spike hit. Very sharp move. And of course, that continued on, but the initial reaction, that's really what I'm looking at here. The fact we hit these levels, and if history repeats, we've just hit it recently, and we've had a minor reaction, and now that may be it. Look at the bounce. We did have a bounce that we hit there just a couple weeks or so ago, and the big question is, will we have a little bit more? Now, I'm not looking for much more because a case has been made that most likely we're in a bear market. So from this point on, that previous bear market, let me clear these drawings. That previous bear market ended in 2009 right here at this point. And these were, these played out for very large moves. So we'd be looking for something closer along the lines that we're looking at here. If the case is that we are in a new bear market. Okay, and to wrap it up, let's just take a quick look at the VIX. The VIX is another way, indirectly, if you will, to measure sentiment. Now, the VIX will look almost like an inverse of the stock market, because when the stock market corrects or sells off, you typically see the VIX move up. The VIX does have predictive value in as much as the market does, when you can look at divergences. In other words, the moves in the VIX are often going to correlate with the moves in the S&P. So if you have let's say a bullish rising wedge in the S&P 500, you'll see sometimes a bullish falling wedge, or the VIX coming down to support with some divergences in place. But most importantly is the VIX over time. This is a 10-year weekly chart. It trades in pretty well-defined trading ranges, high-end and low-end ranges. So back here, from 2007 all the way through 2012, this was the low end of the range. This is just a chart I put up a while back, that ideally if you were trading the VIX, this is when you want to go long the VIX when you came to this range. I always refer to anything in between support and resistance in the VIX as no man's land. It's very tough to trade. If you're going to trade the VIX, you want to wait till it comes down to a support or resistance level. And over time, those levels change. As this bull market went on and aged, just like any point in time, if you go back, at any point in time in history, right towards the end of a bull market, before a bear market begins, complacency is at its highest. People think the market will go up forever just because it's gone up for 6 years. And that's about the average, that was actually one of the longer bull markets in history. So that was the range in the last few years of the bull market, and with the VIX falling to this level. Now, what we're looking at here, we had an upper end of the range. There is a resistance line right here around 32. So this line here, you can see numerous reactions on or around that level going back this is a 10-year chart again. And right now, and most recently in late 2014, we had a surge up to that level. You do see a spike above it, but the next weekly candlestick closed right about on there, and we're at that level now. So I consider this a pretty significant resistance level in the VIX. Now keep in mind, as I said, that it's not coincidence that I just made the case in the beginning of this video that the markets are sitting on support. And if that support breaks, I said that we have about anywhere, depending on what we're looking at, at least maybe a 3% move, I think it was, on the NASDAQ to the next support level. But if we go down below that, I can make a case for a 10% move. So what would happen here, if that flush out move that I talk about, just a small break, let's say we have another 3% downside on the markets, especially in the Qs. I think the S&P will fall a little less. It has been moving down less lately, and that's because of it's more diversified. The Qs are very tech heavy, but that would look something like this. We'll draw it out here. Okay, so if we were to break the lows, the support where we closed on Friday on or about, and we run down another 3% or so in the market, my expectation would be, and I know a lot of you like to trade the VIX, would be for a move up to probably around this, what is that, about 48-ish level, whatever I just talked on a minute ago. And if that worst case scenario I talked about, another 10% down before the markets grab any meaningful support, because that would be at this point about my most bearish intermediate term, even near term, if things really get ugly, would be about another 10% down. We might go up and even take out that level and possibly approach, come close to those 2008 levels there on the VIX. I don't see that right now. I think if the VIX gets up to around that $48 level, 48, that's where and again, you have to correlate this with the stock market. But if the stock market at the same time is approaching support, and we see signs it looks like that support will hold, at least for the near term, this is where you want to short the VIX. Depends on your own strategies, whether you want to sell puts, buy calls on stocks. When I say sell puts here, it means selling puts, or you can, buy on the market. These terms here, selling puts on the market, buying calls. So here you'd want to short the VIX. So you'd be selling calls, buying puts, and or using any of the VIX tracking ETFs. So that's the long and short of it right there, is that we are at support. I slightly favor a little more downside into early next week, followed by a reversal. I think that support will hold for a rally that can last a week, maybe a couple weeks here. And if not, if those levels go, then we could be looking at quick, relatively quick move down, maybe another 10% downside in the markets. And like I said, just looking at the bear flag patterns and knowing where we are, what stage in the market. If this is a bear market, I've talked about the P3 down for the Elliott waivers, primary wave 3. And it looks like, this would be wave one, wave two up, and wave three down is usually an impulsive wave, and that could take us down there. So then the bear market would look like this. You would hit that major target, maybe somewhere in between, but and if this bear market has more to go over time, then you'd have a four up, which would last for probably several months, couple months at least, and then maybe another move down to somewhere around that level. So that's the near and short term outlook for the market. And like I said, we'll just have to see how things open tomorrow, and I'll do some follow-ups shortly before, shortly after the market opens up. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.